Okay, now you covered this, again, from the standpoint of looking back and trying to emphasize a few things. You presumably spent some time last quarter with source rules. And I would hope that you looked at sections 861 through 865 to some extent. And you saw that there's, a bunch of rules in there. And, that's good. The thing that I want to get across is not, what the rules are, but the nature of those rules. Because the nature of those rules is important in working with them and understanding where there are issues that can arise. So it's pretty common around the world that we have source rules, and that those source rules are all based on different categories of income. If you have manufacturing income, gee, normally that's, most countries are going to say, gee, that's where the manufacturing takes place. Trading income, you buy a chair and you sell it somewhere else. The U.S. has a title passage rule. Gee, where was the chair at the point where, under the contract of sale, the ownership of the chair passed from A to B? So, a lot of countries don't use that as a rule. So they might look at, well, where in substance did the transaction take place? Where did the negotiations take place? Where was the contract signed? There's, lots of ways that you could look at this. Fine. Okay, so there can be differences country by country in how you source things. Another aspect of the nature of this is that whenever you put a label on something, that implies that it's that something and not something else. Well, that sort of makes sense. But what if you look at a particular item and you're not sure which label to put on it? Let's say I work in a very technical area, involving chip design. And somebody pays me money to do something for them that is really a combination of intellectual knowledge and service. Which is it? There's no category up there that says technical services that have aspects of both royalty and services. There happen to be a few tax treaties, not very many, but a few tax treaties that include that as a category. But most countries don't have that. The U.S. doesn't have it either. Well, the source rule for services is usually, where the services are performed. But what's the source rule for royalty? Here in the U.S., it's place of use. Think we find that in other countries? Well, maybe not, but a lot of countries and most tax treaties source royalties based not on where it's used, but rather the residence of the company that's making the payment of the royalty. And as you can imagine, that's very attractive to countries that import a lot of intellectual property because they get a withholding tax when the local company makes a payment to a foreign person of the royalty. So the point of this discussion is simply that real transactions, you've got to put them into a box, and sometimes it's not too clear which box they go with very few exceptions, you cannot split the baby, so to speak, and put half in one box and half in the other. Never thought you were going to be Solomon in this course, did you? So this is a real problem with regard to source rules. And later, you've covered something with regard to tax treaties. Well, tax treaties can get agreement between two countries on the definition of each classification and what the source is for that classification. So sometimes these problems can be solved by tax treaties. Sometimes they can't. But this sort of concept that your source rules are based on classification of income and that they're like boxes and you cannot split the transaction between boxes under most circumstances. That's an important thing to keep in mind. I think we got into this a little bit last time, but just to summarize briefly. Remember, source is a gross income concept. When there's a withholding tax involved, nobody cares about expenses. That dividend situation where we said there was a 10% withholding tax. Nobody cares about expenses with regard to that dividend as far as applying the withholding tax at 10% of gross. But that individual G, when he receives the dividend and he has to calculate a foreign tax credit computation on his U.S. tax return on Form 1116, well, he cares about allocating expenses against that dividend income. So there are rules as to how to calculate the expense allocation. Because, we're looking at this and we're only focusing on one item of income. And there's only these expenses. So that sounds simple. But real life is that, whether an individual or whether a company, it has many items of income. Some are the domestic U.S. source. Some are foreign source. Maybe some is interest. Gee, that sounds like that's sort of passive. Maybe there's active business income. There's different types of income. And these types, you've got to, for the foreign tax credit limitation calculation, which we'll get to later, you have to come up with a net income figure. And that means you have to allocate all expenses against the gross income in order to come down to a net income figure. You studied effectively connected income. Effectively connected income is net income. It's not gross income. And you've got to calculate how much there is in the way of allowable expenses against that gross income. So, again, understand that there are important reasons for having extensive rules on how you allocate expenses. Do you need to read all of it in nauseating detail? No, I wouldn't recommend it unless you have insomnia. But paging through it, if you haven't done it during International Tax 1, see what's there. Yeah, that's important. Just to remind ourselves that, yes, we have tax treaties. You studied something about tax treaties in your International Tax 1. We will, during the course, we'll talk about the effect that tax treaties might have on particular situations. Let's see. I guess the principal things that we'll run into as we occasionally talk about treaties when we go forward, the business income treatment under treaties, which is generally pretty common, although of course there can be differences treaty to treaty, but the basic concept of permanent establishment, that business income will only be taxed by the host country to the extent that there is in fact a permanent establishment, that the concept of permanent establishment operates as a threshold. As long as your activities are below that, business income is not taxed by the host country. Once it hits that level, then the host country can tax on a net basis. Again, this is a different version of your effectively connected rules, which you know and love. Except that the threshold for effectively connected is way down here. The threshold for permanent establishment is defined as normally much higher. Treaties normally have provisions for dividends, interest, and royalty. And as I was saying before, they typically have agreed definitions and sourcing rules. And typically there will be a reduction in the tax rate applied. And the last point here, you cannot merely assume that the terms of a treaty will be applied. Advice of local counsel is necessary. The reason being that while things are very nice and clear normally, that a U.S. person is a taxpayer and resident for purposes of the treaty, not always, but usually. In other countries, it's much less so, because they will generally have a residency concept which is based on qualitative and maybe quantitative bases, so that, for example, a corporation incorporated in that other country, if it's managed and controlled in some third country, it might not be a resident. So that's something, and we can talk about that more at some point in the future, if you'd like.